$13 trillion. That is the total assets under management of the world's sovereign wealth funds as of mid-2025. And for the first time in history, the single fastest growing allocation category across those funds is not real estate, not bonds, not infrastructure, it's artificial intelligence and semiconductors. Welcome to Asia Tech Macro. I'm Alex.
And I'm Maya. Today, we're pulling back the curtain on one of the least discussed but most consequential forces in Asian tech investing: government money. GIC, Temasek, Abu Dhabi's MGX, Saudi Arabia's PIF, these are not passive index investors. They are making concentrated strategic bets on the AI and semiconductor landscape that are reshaping deal flow, valuations, and geopolitical alliances simultaneously. And I was just reading Bloomberg's February profile of MGX, and honestly, the scale is staggering.
Let's run the numbers. The sovereign wealth fund universe now encompasses over 100 funds with roughly $13 to $14 trillion in total AUM, up from $11.6 trillion in 2022. The Middle East and Asia dominate. Saudi Arabia's PIF at $1.15 trillion, Abu Dhabi's ADIA at $1.11 trillion, China's CIC at $1.33 trillion, Singapore's GIC at approximately $936 billion, and Temasek at $320 billion. Norway's GPFG remains the world's largest single fund at $1.86 trillion, but is structurally prevented from concentrated tech bets by its mandate.
And the story of early 2026 is Abu Dhabi's MGX. Established in 2024 by Mubadala and G42, MGX targets $100 billion in AUM and aims to deploy $10 billion in deals annually. In February 2026, Bloomberg reported MGX is exploring a $50 billion third-party capital raise with a minimum LP ticket size of $500 million. Its existing portfolio already includes OpenAI, Elon Musk's xAI, Databricks, and a 51% stake in Altera, Intel's programmable chip business, acquired jointly with Silver Lake. MGX also co-founded the Stargate project alongside OpenAI, SoftBank, and Oracle. This is not a passive financial investor. This is a sovereign entity building strategic positions across the entire AI stack simultaneously.
And Singapore is moving in parallel, but with a different style. Temasek announced in August 2025 that it will restructure into 3 wholly owned entities effective April 2026: Temasek Global Investments, Temasek Singapore, and Temasek Partnership Solutions. The restructuring signals a strategic pivot toward more concentrated global tech mandates. Meanwhile, Bloomberg reported on February 4th that both GIC and Temasek are revamping their hedge fund relationships, GIC replacing its veteran external manager's head and hiring additional staff, Temasek expanding its outreach to a wider pool of hedge funds. These are operational signals of a broader strategic reorientation toward higher conviction, higher velocity investing.
But there's a performance cloud over Singapore's funds right now that's worth acknowledging. GIC reported a 20-year annualized real return of 3.8% for the year ended March 2025, its weakest since 2020. Temasek's 10-year total shareholder return came in at 5%, lagging major equity benchmarks. Singapore's parliament raised questions in January 2026, with Senior Minister of State for Finance Jeffrey Syao defending both funds as operating within expectations. The timing is awkward, restructuring and strategy pivots announced against a backdrop of below benchmark returns.
Which sets up a fascinating structural tension that we're going to dig into in segment 2, because the question of whether sovereign wealth funds should be patient long-term capital allocators or active strategic investors is not just philosophical. It has direct implications for how they move markets and where the smart money signal actually points. Stay with us. Okay, segment 2. Let's get into the strategic tension. Because GIC and MGX represent almost opposite ends of the sovereign wealth investment philosophy spectrum, and understanding that difference matters enormously for interpreting their portfolio signals.
Right. GIC's mandate is explicit: preserve and enhance the international purchasing power of Singapore's reserves over a 20-year investment horizon. That mandate structurally favors diversification, risk management, and steady compounding over concentrated bets. GIC's portfolio is roughly 34% U.S. equities, 19% Asia ex-Japan, 12% Japan. When GIC invests in AI or semiconductors, it does so as part of a broadly diversified book where no single theme dominates.
MGX is the mirror image. Its entire mandate is concentrated AI and semiconductor exposure, infrastructure, chip design, AI applications. When MGX co-invests in the Stargate project at a scale of hundreds of billions of dollars, it's not portfolio diversification. It's a sovereign entity making an explicit bet that AI infrastructure is the defining strategic asset of the next 2 decades. That's a fundamentally different signal from GIC buying a 2% stake in a semiconductor ETF.
And here's the investment implication that I think gets missed. When MGX takes a position, it moves markets because it brings not just capital, but deal access, regulatory relationships, and geopolitical alliance. The Bloomberg profile noted that MGX gets, and I want to be careful here about how I characterize this, what one executive described as exclusive opportunities that most investors cannot access. That's not a financial advantage. That's a structural advantage rooted in Abu Dhabi's sovereign relationships with the US, with NVIDIA, with OpenAI. You cannot replicate that alpha through normal investment channels.
Okay, devil's advocate. Isn't that kind of privileged deal access actually a warning sign for other investors rather than a signal to follow? If MGX is getting into deals at terms that reflect its political relationships rather than pure market pricing, the valuations it pays may not reflect genuine risk-adjusted returns. And history is littered with sovereign funds that paid strategic premiums for technology assets that subsequently underperformed, GIC's 2007 UBS investment being the most cited example.
That's the critical counter, and it's fair. But the 2007 comparison may not hold. The UBS investment was a financial sector bet made at the peak of a credit bubble. MGX's semiconductor and AI infrastructure bets are being made at a moment when the U.S. government itself is explicitly co-investing in the same assets through the CHIPS Act, export controls, and Stargate. When sovereign capital and policy direction are aligned rather than divergent, the risk profile is structurally different.
Which brings us to segment 3, the ripple effect. Because these sovereign fund moves are directly reshaping deal dynamics for every private equity and venture capital fund investing in Asian tech. GIC was the largest sovereign wealth fund investor in European startups in 2024 at $1.9 billion, according to global SWF data. But more importantly, GIC and Temasek's presence in an Asian tech deal round now functions as a quality signal for other investors, particularly for deals in India, Southeast Asia, and the semiconductor supply chain.
And the Korea angle is worth flagging. Korea's own sovereign investment vehicles, KIDC, the Korea Investment Corporation, have been quietly expanding their direct tech investment mandates. KIC's AUM crossed $200 billion in 2025, and its technology allocation has been increasing. For Korean battery and semiconductor companies navigating capital-intensive transitions, KIC's evolving mandate creates a new domestic funding backstop that wasn't available 5 years ago.
The broader pattern is clear. Sovereign capital is no longer a passive late-stage participant in Asian tech. It is increasingly a first mover in strategic sectors where governments have decided the stakes are too high to leave entirely to private markets. And in part 3, I want to challenge whether that sovereign capital influx is actually good for Asian tech valuations, or whether it's creating a dangerous new source of market distortion. Don't go anywhere.
All right, contrarian corner. And my uncomfortable view today is this. Sovereign wealth fund money flowing into AI and semiconductors is being celebrated as validation of the sector. I think it's a warning sign dressed up as a vote of confidence.
That's a strong take. Walk me through it.
Here's the argument. Sovereign wealth funds have a structural problem that private investors don't. They cannot exit. When GIC takes a large position in a private AI infrastructure company, it cannot quietly sell that stake if the thesis deteriorates without sending a catastrophic signal to the market. When MGX co-invests in Stargate at sovereign scale, Abu Dhabi's geopolitical relationships make a clean exit functionally impossible, regardless of financial performance. This means sovereign capital is inherently sticky in ways that distort price signals. When the exit pressure that normally disciplines valuations is removed, prices can stay elevated far beyond what fundamentals justify.
But isn't that stickiness actually a feature rather than a bug for the companies receiving that capital? If you're Anthropic or a semiconductor fab, having a sovereign investor who will never panic sell is incredibly valuable for long-term planning and capital stability.
It's valuable for the companies, absolutely, but it's potentially dangerous for the other investors who use sovereign fund participation as a quality signal. Here's the specific risk. When MGX or GIC marks their private AI portfolio at inflated valuations because they can't sell and the marks are theoretical, those valuations become reference points for the next funding round. Private market valuations compound on top of sticky sovereign marks. That's a mechanism for creating and sustaining bubbles in exactly the sectors where sovereign funds are most concentrated. And those bubbles eventually reach public markets through IPOs.
So the bear case is sovereign capital creates a valuation floor in private AI markets that has nothing to do with cash flow fundamentals, and retail investors end up holding the bag when those companies eventually go public.
Precisely.
And there's a historical precedent that's uncomfortably close. SoftBank's Vision Fund played exactly this role in 2017 to 2019, providing massive capital at inflated valuations that became reference marks for an entire ecosystem. WeWork, Uber, and dozens of smaller companies were valued against SoftBank marks that didn't reflect reality. The Vision Fund was private capital, not sovereign, but the dynamic, large, non-economic actors setting reference valuations for an entire sector is structurally identical to what sovereign funds are doing in AI today.
That's a sharp parallel, though I'd push back slightly. SoftBank was deploying capital with venture-style return expectations and a fund lifecycle that created its own exit pressure. Sovereign funds don't have that lifecycle constraint. The distortion mechanism is similar, but the trigger for unwinding is different and potentially much slower.
Fair distinction. The unwinding may be slower, which means the distortion persists longer and infects more capital before it corrects. And here's the question I want our listeners to sit with. Sovereign wealth funds are the ultimate smart money signal. They have access to the best deal flow, the best advisors, the best geopolitical intelligence. When GIC, Temasek, and MGX are all moving toward AI and semiconductor concentration simultaneously, the consensus interpretation is this is where the next decade of returns will be generated. But here's my question. Is that concentration a signal that AI infrastructure is genuinely undervalued, or is it a signal that the world's largest pools of non-economic, strategically motivated capital have decided to allocate there regardless of price? Because those are very different propositions with very different implications for everyone else in the market. Part 4 has our answer. Stay with us. All right, action items. 3 concrete things to do with everything we discussed today.
Number 1. Use sovereign fund portfolio disclosures as a sector signal, not a stock signal. When GIC or Temasek discloses increased allocation to AI infrastructure or semiconductor supply chain in their annual reports, treat that as confirmation of a multi-decade structural theme, not as a trigger to buy specific names at current prices. The sovereign signal tells you the direction is right. It tells you nothing about whether today's valuations already price in that direction. The most actionable sovereign signal is new geographic exposure. When GIC enters a market it hasn't historically been active in, that's a more meaningful read-through than incremental additions to existing positions.
Number 2, be cautious about private AI company valuations that have sovereign fund marks as their primary reference point. If a company's last funding round was led by MGX or another sovereign entity at a valuation that implies 40 to 50 times forward revenue, treat that mark skeptically when it shows up as a reference in subsequent rounds or pre-IPO secondary transactions. Sovereign investors are not optimizing for the same return targets as private equity. Their marks are not price discovery, they are strategic positioning. The correction happens at IPO when public market investors apply different discount rates.
Number 3. Watch KIC and KDIC's evolving direct investment mandates as an underappreciated catalyst for Korean tech. Korea's sovereign vehicles have historically been passive, diversified, and slow-moving. The shift toward direct technology investment, particularly in battery supply chain and AI semiconductor design, represents a new domestic funding backstop for Korean companies navigating expensive technology transitions. If KIC announces a dedicated technology direct investment vehicle in 2026, which industry sources suggest is under discussion, it would meaningfully change the funding landscape for mid-tier Korean tech companies that currently rely almost entirely on private capital markets.
The takeaway for today: sovereign wealth funds are no longer passive participants in Asian tech. They are strategic first movers with non-economic motivations, indefinite time horizons, and geopolitical relationships that create deal access no private investor can replicate. That makes them powerful market-moving forces. It also makes them potential sources of valuation distortion in exactly the sectors, AI, semiconductors, energy storage, where they are most concentrated. The investors who navigate this correctly will use sovereign signals to confirm directional themes while applying their own independent valuation discipline rather than following sovereign marks as price benchmarks.
And the meta lesson: when the world's largest non-economic actors all move in the same direction simultaneously, it tells you something important about the future. It tells you almost nothing about whether the price is right today.
Next time on Asia Tech Macro, we're diving into the rise of Southeast Asia's homegrown tech giants. Grab, C Limited, GoTo, 3 companies that were supposed to be the Uber, Amazon, and Gojek of the region. 5 years on, which thesis held up, which didn't, and what does the next chapter look like as AI changes their competitive dynamics? That's next.
Really looking forward to that one. The Southeast Asia consumer story is overdue for a proper reassessment.
Stay data-driven. Bye.